Hello and welcome. Today we're going to be talking about an NBFC. Name is Mass Financial. What we're going to be trying to understand better from the company is, one, has the MSME cycle in terms of credit cost turned? That's the one thing, and they have a good pulse of what happens on ground because they've been in this business for now since 1995. So now it's been nearly 30 years since that they've entered this business and they're doing it, and therefore it gives you a better sense as to what's playing out on ground with regard to MSME. So that's the first thing I want to know. The second thing is with regard to what insulates them versus the rest of the industry. I'd also want to understand what their secured versus unsecured book is. My understanding is 70-30 secured versus unsecured. But just the way in which NPAs behave across cycles with regard to where Mass Financial is concerned, that's what really stands out for me. So we'll try and get a perspective on what insulates them from the rest of the industry where the MSME cycle is concerned. The third piece is with regard to geographic concentration risk. They've got the top 5 states contributing over 70% of their AUM. Whether going forward, as they scale from this sub 15,000 crore AUM number towards 1 lakh crore, mind you, that is the aspiration by FY36. What or how does it play out essentially in terms of geographic concentration? What plays out? Do they deconcentrate themselves from this kind of west zone that they are clustered around, is what I'd want to know. Fourth piece is with regard to the housing finance business listing. That could be one big value unlock which could likely play out going forward. And the fifth piece is with regard to ROEs. They've fallen slightly. They're at roughly 13 to 15% last 4 to 5 years, but the goal and the aspiration is to get it to 17. What are the levers available and how quickly do they get there? Really, that's what I'd want to know. And let's try and get a better sense from management when we speak with them. But first, as always, let's talk about the company and let's try and get a sense of what it does. It's a Gujarat-based NBFC lender incorporated in 1995. I spoke about this 30-year-old company. It's a non-bank lender focused on underserved retail as well as MSME. It's done 6x AUM growth and 8x in profitability in the last 10 years. That's decently healthy compounding that the company has done. Mind you, 4x in 10 years roughly means a 15% compounding. 6x is around 20+% in terms of the compounding. So this has been a good compounding story, to say the least, over the last decade or so. Now, in terms of product, they do micro enterprise lending, which is roughly 5,500 crore of the book of around sub 15,000 crore. SME is around 4,900 crore. So what you're seeing is a heavy concentration in those two buckets. But despite that, we've not seen NPAs inch up significantly, and we'll give you a sense of how that plays out. Two-wheeler is something they're relatively newer in. Also, CV is the other piece that they are relatively newer in, around 2,000 crore book between two-wheeler and CV. And then there's salaried loan and housing loan as well. And the housing loan or housing finance subsidiary, the current AUM is around 859 crore. So 860 crore rounded number is what I have taken in INR crore in terms of that book. Now let's talk about the distribution. How do they go about disbursing loans? They have a presence across 13 states. They have 208 branches. They have 15,500 customer locations which they access. Then they have direct selling agents, because that's the other way that they sell. There are referrals also that they sell through digital media and marketing, and then there's call centers through which they sell loans. So broadly, that's the distribution and the make. In terms of states, largest presence, in fact, over 30% or over 30 branches each are present in Gujarat, Rajasthan, Madhya Pradesh and Maharashtra. In fact, 30% of the branches are placed in Gujarat. Rajasthan also has a very, very healthy mix in terms of the number of branches versus the overall, which is 208. Madhya Pradesh, Maharashtra, all of them having over 30 branches on a base of 208. So you've got that very, very concentrated western, come maybe Madhya Pradesh kind of belt where they are largely concentrated. Of course, they do other lending as well through NBFCs and through other modes in other states outside these 13 states where they have these branches. So broadly, that's the other way in which they do their distribution and sales. Now let's talk about the metrics. And in terms of the net interest income, it's grown at a very healthy 33% CAGR over the last 3 years. So that's been fairly healthy. In terms of operating profit as well, there's been a 30% growth over the last 3 years. There's been an inch up with regard to OPEX. We'll talk about it when we talk about the operating ratios or the metrics that we talk about when we look at the cost to income or cost to assets ratio. And we'll see that. So profit growth slightly lower in that sense. The impairments or the provisioning has gone up sharply in comparison, but of a very, very low base. And therefore, that currently stands at around 126 crore. I wonder if this comes off a little bit, starting maybe FY26 end and FY27. And last off is with regard to the profit after tax. That's grown at a very, very healthy 25% on a YOY basis over the last 3 years. So that's very decent compounding across the board that we've seen, at least over the last 3 years. And therefore, that warrants a thumbs up. In terms of the balance sheet, let's pull that one up. There's a 25% AUM growth that we've seen over the last 3 years. Currently, of course, while FY25 numbers is 12,100 crore, the current AUM stands at just shy of 15,000 crore. So that's the other thing you want to note. But again, the compounding has been healthy when we are seeing it. In terms of Q1 FY26, the AUM was at 12,500 crore, Q2 was at 13,000 crore, and Q3 is at 13,800 crore in terms of AUM. So that's really how it's placed. In terms of operational metrics, so again, the growth is decent. We've given this a thumbs up as well. Let's move on. Operational metrics in terms of yields, it clocks anything between 13.5% to 16% in terms of its yields. Yields have inched upwards as they ventured into these newer products as well. So that's the other piece that you want to keep your eye out on. That was the capital adequacy ratio, by the way. Can I go back a slide? The capital adequacy ratio is at a healthy kind of level. So no concerns with regard to fundraising, at least at this point. 24.7% is where the capital adequacy currently sits at. So that's the other piece I wanted to mark. So yes. Now let's look at the yield on advances. It's at roughly 16%. There's been an inch up as new products have come in. The cost of funds is also inched up, and that's because of the repo rate changes that have happened. I'm curious to also know, as the credit rating changes on this and as credit rating improvements happen, can there be a squeeze on this number? So that's another piece which I've probably missed in putting in what I want to know, but I want to know it. When I'm looking at the cost of funds, it strikes me. In terms of the margin number, it's gone up on a consistent basis from 5.8. We're currently sitting at 7.1. We'll try and understand what margin levers are available as well. The cost to income, this is where it starts to get interesting. Was at sub 20, it's gone up very sharply. Currently, it's sitting at 31% cost to income. This is because the branch count has gone up over the last 3 years. They were at 100 branches 3 years ago. They're currently at 208. What that has led to is OPEX going up substantially. Employee costs, the cost of rentals, offices that they maintain, and the branches that they have to upkeep. That cost has gone up. Well, this is an interesting play. Could this probably stay steady state here? What's the future trajectory? We'll try and get a sense of that as well, because as the vintage grows, the income level will start to inch upwards, but your OPEX efficiency will start to likely play out on this number. So we'll try and get a sense of what plays out. Now, in terms of that's cost to income, look at the ROA number. It's fairly steady. It trades in a very narrow band in terms of ROA. The return on assets was 2.7% FY22. We'll correct these numbers. 2.71% FY22, 2.8% FY23, 2.75% FY24, and 2.84% FY25. But that's broadly the band in which the ROAs have trended in. So that's something to note as well. Now let's talk about asset quality and gross stage 3 and net stage 3, which is GNPA and NPA equivalent. Again, the band has been very, very narrow. It's inched upwards, there's no doubt about that, but it trades in that 2.3% GNPA to around 2.6% GNPA kind of number. And the net stage 3 also trades in this 1.5 to 1.7% band. So it's very, very tight in terms of the GNPA and NPA trend. And in fact, there's a very interesting slide in the investor deck, which they share every quarter, where you have the last 120 quarters of how this has played out in terms of a trend. And that looked very, very interesting to me, that this trades in a very, very tight band in terms of NPAs. Again, the FY22 NPA number of 1.34 is incorrect. There's a 1.7% net NPA number in FY22, which this one has clocked. So that's the other thing that I'd want to change. In terms of valuations now, and really everything has to be looked at from a valuation standpoint, right? You don't have too many comparisons here in terms of the kind of loan book that Mass has is slightly unique in that sense. But the book value per share is at roughly 154. It does around 17 to 18 rupees of EPS trailing 12. And it has a market price of around 336, 340 at the moment. So it's trading at around 2.2 times current book and around 1.9 times 1 year forward book. That's really where it sits at, which is broadly in line with the way in which it's always traded. And therefore, we've given this a neutral. In terms of the analyst recommendations, there are 7 buy calls though. So plenty of bullish analysts there on the street, no holds, no sells, with a 22% upside. So there's a thumbs up there on that count. In terms of the 2 other pieces that I want to quickly cover, one is the ROEs. We spoke about this metric, by the way. So the ROE metric, it roughly fluctuates between the 13 to 15% band. That's how the last 4 years have been in terms of ROE. But the aspiration is to get it towards 17%. Really, that is the goal, and we'll try and get a sense on the timing of that. The shareholding pattern, it's very well and very closely held by the promoter group. 67% is held by the promoter group. It's a 6,000 crore market cap company. 2,000 crore is the free float on this one. Therefore, and 3% by FIs. There is, of course, DI participation, and then the public holds just about 10%. There's been a sharp reduction in the number of shareholders as well that Mass Financial has. And that's the other piece, that generally, when there is a frenzy, the number of shareholders go up. But the fact that number of shareholders comes down is the other metric that we typically track. So that's the other one that kind of stood out for me when I was looking at the data. But that's broadly how Mass stacks up. Let me bring on board Mr. Kamlesh Gandhi, who's the Chairman Managing Director at Mass Financial Services, to talk to us about how he's looking at the business. Mr. Gandhi, let me first start off by trying to contextualize how MSME is playing out for you. Talk to us about what trends you're seeing on ground. Is the worst over in terms of the MSME pain industry-wide? And do you believe that now we'd start to see a sustained uptick or a meaningful uptick going into Q4 and FY27?
Thank you. And I should compliment you for a very detailed analysis. And once you have done this, I have very little to answer now. So on the MSME...
Thank you, Mr. Gandhi. That's very kind of you.
On the MSME piece, let me tell you that as I shared in my last investor call, analyst call, that we are seeing the increase in the eligible demand slowly and gradually. Our gauge of how the markets are behaving is from the point of view of the eligible demand we get. And where we had gone dismally to a single digit eligible demand, that has been increasing slowly and gradually. And we see that within next 2 quarters, hopefully, we should come back to normal, or maybe a quarter or 2 here or there. And how the MSME lenders will tend to perform depends upon the individual lenders' approach to asset creation. As you very rightly told that we are a 30 years old company, one of the oldest financiers in this segment. We have taken our own time. 30 years is a very long time. And you mentioned about that slide of 123 quarters. So we took 123 quarters. We started with a very small base of 2 crores. And right now we are at around close to 15,000 crores, translates into 30% plus growth. But I must say that we were courageous to be patient. And now we are at a very strategic inflection point. And that is where Team Mass now aims at a 10-year vision, where we think that a lakh crore AUM is absolutely feasible.
Absolutely. So talk to us. You said that there is single-digit eligibility, maybe a few quarters ago, with regard to MSMEs wanting to borrow from you. What is the normalized eligibility that Mass typically sees? Can you give us a sense of that, just so that I know directionally where we are in the cycle?
We are at around, normally it's anywhere between 25 to 30%. We had gone down to single digit. Now it is coming up. It is in the early teens or mid-teens. And within the next 2 to 3 quarters, I think we should see that eligibility coming back once again.
And that will deliver growth in excess of 20-25% likely for you. You've guided 21. If I'm extrapolating your numbers from 14,000 odd crore to 1 lakh crore, you're guiding for 21%, but in the near term, you'll likely grow at a much faster clip, right? So does FY27 visibility for growth be more than 25%? Is that something we can pencil in?
No, Vibhu, I would not like to share that view because it all depends upon what type of quality we discover at the marketplace. These are all assumptions that it should, the eligible demand should increase, but what are the other macros playing out? We don't know. And we would still like to maintain a range bound growth anywhere between 20 to 25%. And if, as I've always told and shared, that we would like to discover growth rather than determine growth. So if we get an opportunity, sometimes why not? But as a company, and if I have to share my views, it will be anywhere between 20 to 25%.
So a secured to unsecured mix. Oh, okay. Before I go to secured to unsecured, what keeps you differentiated, or what keeps the pain away from mass financial, especially in cycles where things go south or become difficult for the sector as a whole? Is it, of course, it's better lending practices, very, very likely, but do you lend to a far smaller cohort of customers versus the rest of the industry? And does that mean that pricing gets impacted for you? How do you maintain pricing and yet maintain quality of customers? I'm trying to get a sense of that.
See, as it is stated, the good time is the most challenging time for a business if you don't understand it rightly. So the asset created during the good times, they will determine the quality during the challenging times. So if you say 2 years back, everybody wanted to grow very fast. Anybody growing less than 35-40% was considered an outlier and a company not capable to grow. Where and during those period also we maintained a very strict credit discipline, despite of the fact that the data was showing other way around. But we knew that the way the lending is happening, the borrower is likely to get over leverage. So preemptive things earlier has been our trait. And when you preempt things earlier, you need to be a little different from the market at the times when market are growing very fast. You choose to grow very selectively and in a calibrated manner. So when really a cycle kicks in, those things that were taken care of at time of dispensing credit during good times helps you to remain in a good state. So that has been our philosophy, and that has been our belief during all these 30 years of working, that we try to do what we think is right for the borrowers and not just go by the momentum.
Mr. Gandhi, if you grow at 20 to 25% over the next 3 years, which is all the way up to FY, say 29, FY 30, you'll be at 30,000 crore in terms of your loan book size. What changes for you? Does the geographic mix change? Does the secured to unsecured mix change? What changes as you grow from, say, sub 15,000 to 30,000 crore?
Obviously, the geographic mix will change because we are trying to penetrate deep in South. We are also trying to establish ourselves in North. When we talk about North, is Rajasthan, Delhi, NCR, few good pockets in UP and Uttarakhand and all. So we would definitely have a larger footprint across the country, and geographically our presence in South and North will be cognizable. In terms of the product, Wheels and SME will contribute more than what they are doing right now. We are focusing a lot on SME and Wheels, and also housing should also contribute meaningfully. So on the asset side, the key drivers will be SME, Wheels, and housing. And on the distribution side, we will increase our branches and we will increase our penetration in our area of working also.
So SME, Wheels, housing, as you venture into newer geographies and into newer product, what is the risk that comes out of this in terms of processes? You likely need to tweak those processes to kind of fit into the product as well as the geographic market. How confident are you that you can continue to do, because you've always guided for this number, 2.7% odd ROA, despite doing all of these different products and geographies?
So whenever we enter new geographies, fundamental does not get dilute, extending credit where it is due. We take our own time to understand the demography. We do our own analysis, and now with the help of lot of data available through credit bureau scrubs and through our personal site visits and understanding of the demography, we design our credit screens, which are far too conservative when we start. And then once we understand and once we have the confidence, we go on relaxing it to in order to match the market aspirations. So that has been a well led down process. So whenever we start a new geography, we are cautious. And when we are confident about the people, the processes, the understanding of the demography, we pick up on numbers.
Okay. And Mr. Gandhi, give me a sense of what happens with regard to your OPEX ratios, because they've really shot up. Now, I'm trying to understand as these branches of 208 start to gather vintage, how does efficiency play out on your cost to income? And also, how do you grow your branches? What's the kind of glide path going forward? Because certainly you're not going to double in the next 3 years, or are you?
See, on the part of OPEX, I've shared a number of times that the right way is to say that how we are going to maintain our ROS between 2.75 to 3%. Because OPEX is very dynamic to the asset configuration. Say for example, this quarter I have more of two-wheeler or more of commercial vehicle, which is high OPEX heavy, but at the same time, the yields I get is high. So our target is not just containing OPEX, but we go by unit dynamics. So you don't go wrong on the aggregate level. So when the assets are created, we see to that each one should contribute anywhere between 2.75 to 3% in ROS, and the OPEX will vary accordingly. Obviously, as you rightly told, that from 100 branches to 208 branches and likely to reach to close to around 300 to 350 branches within next 2 to 3 years, depending upon the opportunity and depending upon our capabilities to manage the distribution, that cost will definitely increase. But we will take care in such a manner that the ROAs are maintained anywhere between 2.75 to 3%. We don't upfront the expenditure substantially. And that is where you take a lot of time to grow. So there are companies who have grown to 15,000 crores in 5 years flat. But it has consequences or it has different, those companies have different objective. Whereas in our case, while maintaining 2.75, any ROS between 2.75 to 3%, it takes time to grow, but the growth is non-dilutive and through internal accruals. So this is the path we have chosen for ourselves, that we like to keep the ROS any between 2.75 to 3%, and OPEX will be dynamic depending upon the assets that has been created or quarter on quarter. But ultimately, if you have seen that our OPEX have increased, but we have maintained our ROS.
Mr. Gandhi, two pieces. One is on ROE and one is on any potential fundraise. As you obviously have a glide path towards 1 lakh crore in terms of AUM, what's the near-term ROE visibility looking like? When do you hit that 17% number which you're aspiring for? And when does the fundraise thereafter happen? Because that will likely dilute your ROE as well. So I'm trying to get a sense.
So in terms of ROE, if you say that we raised 500 crores approximately 1.5 years back, we are yet to sweat that completely. We are at around 3.5 to 3.6 times debt equity. We would like to take our debt equity to 4.5 and the overall leverage to 5.5. So the maths is like that overall leverage of 5.5, and if we can reach ROAs of around 3, will result into 16.5 to 17% ROEs. But it is around few quarters away. Difficult to predict exactly when it will happen. But we are well on track, and we all are endeavoring on those directions. So two things will happen. There are two determinants of ROE: the leverage and the ROS. So leverage will increase gradually, and ROS also we are trying to increase gradually with reaching critical mass at every branch.
Thank you so much, Mr. Gandhi. It was great speaking with you, great getting this perspective where Mass Financial is concerned. Thanks so much for coming in and speaking with us. And viewers, completely out of time on this edition of AYC. We'll leave it at that. Thank you so much for watching.